Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. Chicago wheat. I've highlighted here two patterns that are currently running what is going on in this market. Both are bearish. The first is highlighted in dark blue on my daily chart and is the early November 2022 to February 2023 bearish Andrews pitchfork. The market has mainly been between the upper time, currently 621, and the middle time below, currently 557. The upper time has been breached on many occasions, though not properly broken as yet. There is a second newer pattern, a bear channel, currently 571 to 653. For the February to date action. This is especially significant given how the upper bear channel line had been in lockstep with the declining short medium moving average, currently 662, between late March until late May, though it is still close. Needless to say, their combined bearish pressure would be greater than each one individually. Finally, 2 weeks ago we had a weekly key reversal down. This has this week seen a follow through lower, though the attempt has been limited with the market moving down from the upper time, but not getting much past the March 2021 low at 592 before reverting back up again. So where does that leave us with respect to the downside? Well, the July 2021 low at 609 has held up the market for the most part throughout May, though the downward pressure of the upper time means that by mid-June we will see one or other of these give way. This also applies to downward pressure from the upper bear channel line, which will cross over the July 2021 low by early July. So at the moment, despite the current move over the upper time, the July low still looks vulnerable. Below this, we have the previously mentioned March 2021 low at 592. And beyond that, we have the lower bull channel line and the middle time, along with the December 2020 low at 566. Chicago corn. The obvious feature here is the huge gapping move lower 3 weeks ago. The market was led lower prior to this move down by earlier bearish patterns and actions. Notably, the true break below the late April of the purple lower time, currently at 626 of the September 2021 to July 2022 bullish shift pitchfork, made back actually in mid-April. This bullish shift pitchfork had until March this year never been tested on the downside, but the middle time above, which is up off the top of my daily chart, had managed to cap the market back in late September and October of last year. Hence, as I said 9 weeks ago, it deserved some respect. Thus we saw it earlier hold up the market throughout March and April, stymieing opportunities to reach the potential big bear flag target in the 490 zone. This was actually from the February 2022 to May 2023 bear flag. However, 5 weeks ago, the breach of the lower purple time was not only a weekly key reversal down, but more importantly also a monthly key reversal down for April. This finally was enough to set prices moving lower. The gapping action lower went straight through the 50% Fibonacci line of the April 2020 to April 22 move at 567, the July 2013 high at 564, the 2022 low at 562, the combination of the 2014 high and 61.8% absolute Fibonacci line at 525, and even the October 2021 low at 516. This showed the very effective remnants of the move down, and it was only congestion between 502 to 491, with the 2021 low at 498 within it, that finally halted the decline. So what have we seen since? Well, there is some previous form in this market at holding at this 502 to 491 region, with, as I say, the 2021 low at 498, which is backed up on the longer term charts with a slowly rising 5-year moving average at 501 1/4. And for now, these together have started a small recovery this past 2.5 weeks, and a filling in of the changeover gap between 519.5 down to 472 3/4. Otherwise, below we have congestion of 469 to 465, and at 449, 444, and 436 to 410 even. But the next big support is the 50% absolute Fibonacci line at 424, and there's quite a lot to swallow. So I've seen this week, these weeks actually, a move up, and last week and this, and that's up to the lower end of the gap, but not as yet really trying and filling it in. It's been with hesitancy we've seen this rise, just over the combination of the 2014 high and the 61.8% absolute Fibonacci line at 525. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.